The day your net worth crosses $750,000, something changes. It is not the market. The market has no idea what your balance is. What changed is the size of a normal bad day. Think back to when your account held $50,000. The market drops 25%, the way it did in 2008 and again in early 2020. On $50,000, that hurts. But it is a number you can stomach. Now run the same drop on your new balance. That same 25% is $187,000. Gone in a few weeks. That one loss is about 3/4 of everything a typical 50-year-old American owns. A crash like that is rare. An ordinary down day is not. But 2 or 3% drop happens a dozen times in a busy year. Back when you had $50,000, a 3% day was $1,500. You shrugged and went to lunch. On $750,000, that same day moves more than $22,000. For most people, that is more than they can save in a whole year. It slides in and out of the account before noon. That is the first thing this number does. It makes an ordinary Tuesday big enough to scare you. And a scared investor is a dangerous thing. Scared investors sell at the bottom and undo 20 years of patience in a single afternoon. But the crash is not the real danger here. There is a quieter one waiting at this exact number, and over a lifetime it takes far more. I'm Tom. This channel is about real personal finance, the kind that works for normal people instead of the kind that sells you something. No motivational fluff, no fantasy returns, no get rich quick. Just what the math actually does over time. If that is what you want, hit subscribe. My neighbor Ron is in his 50s. He runs operations at a mid-sized company. He is not a flashy guy. For 12 years, he drove the same truck, and for 30 years, he did the boring, correct thing. He maxed his 401k, he never panic sold, and he let it compound. Last spring, between his retirement account and a little on the side, Ron crossed $750,000 for the first time. And that is when his phone started ringing. It was not one call. It was a pattern. A letter arrived offering a free portfolio review. A man he barely knew from church had just gotten into financial services. He would love to buy Ron a coffee. An invitation showed up for a steak dinner with a short retirement presentation attached. Ron had lived his whole life without any of these people caring about him. Then his number crossed a line, and suddenly he was popular. None of it was about Ron. It was about his balance. $750,000 is a threshold. Below it, the financial industry mostly leaves you alone. You are not worth the effort. Nobody builds a sales pitch for a person with $8,000 in checking. But once you cross this line, 1% of your money becomes real money to somebody else. 1% of Ron's balance is worth a salesperson's whole afternoon. So the salespeople came. The most respectable slice is the management fee. Most advisors charge about 1% of your money every year. Industry fee surveys show that 1% is the going rate for accounts this size. 1% sounds like a rounding error. On Ron's balance, that 1% is $7,500 in the very first year. And that is a car payment every year handed over for help he may not need. But the yearly bill is not the real damage. The real damage is what 1% does across decades. Take his $750,000 and leave it completely alone for 30 years. Use a 7% return after inflation. That is close to what the US stock market has actually delivered over the long run, according to the historical data kept by NYU Stern. Left alone, Ron's money grows to about $5.7 million. Now hand 1% a year to an advisor. Same money, same market, same 30 years. It grows to about $4.3 million instead. The gap is $1.4 million. After 10 years, the fee has cost Ron a little over $130,000. Annoying, but survivable. After 20 years, the gap has ballooned to nearly $500,000. By year 30, it is that full $1.4 million. The cost does not climb in a straight line. It accelerates. Every dollar the fee removes is a dollar that stops compounding. Across those 30 years, Ron does not actually hand over $1.4 million. He hands over about $586,000. The other $800,000 is the growth those fee dollars would have earned if they had stayed in his account. So every single dollar he pays this man costs him about $2.39 in the end. You can see it in 1 year alone. That $7,500 Ron pays in the first year looks small and reasonable. But say you kept it and invested it instead. 30 years later, it would be worth about $57,000. Stack that across 30 years of payments, and you have the $1.4 million. Nobody robbed Ron. There was no crash. Each year the bill felt fair. $7,000 for a professional to watch his account seemed reasonable in isolation. But a small slice off the top, taken every year, compounds against you exactly the way your returns compound for you. That is the whole trick. The fee grows right alongside your money, and it grows in total silence. There is another way to see the size of it, and this one lands harder if you are close to retiring. The common guideline is that you can pull about 4% of your savings a year. On $750,000, that is $30,000 of annual income. Now put the fee next to it. $7,500 against $30,000 of income is one full quarter. 12 months of retirement paychecks, and 3 of them go to your advisor before you see a dime. The advisor's 1% is often not the only fee. The funds they put you in charge their own fee on top. So you might pay 1% to the advisor, then another 0.5% is buried inside the products themselves. Nobody ever says those two numbers out loud together. You have to add them up yourself. Does that fee buy him anything? Sometimes the answer is yes. A genuinely good advisor who stops you from selling in a crash can be worth the money. That one saved mistake is bigger than years of fees. Morningstar studies how ordinary investors do against the very funds they own. Over the 10 years through 2024, the average investor earned about 1.2% less each year than their own funds returned. The whole gap came from buying and selling at the wrong moments. A person who keeps you still through the scary years is worth paying for. But very often the fee does not buy you that. It just buys you a person who puts your savings into the same simple index funds you could have bought yourself. Those funds cost about 0.03%. On Ron's balance, that is around $200 a year. He would be paying a professional price for a do-it-yourself product. There is also a middle path almost nobody mentions. A computer-run service, sometimes called a robo-advisor, will build and manage a sensible portfolio for around 0.25%. On Ron's balance, that is under $2,000 a year instead of $7,500. It is not as personal as a human, but for a lot of people it does the same core job for 1/4 of the price. The expensive option is not automatically the best one. Ron newly walked into the trap that catches people at this exact number. It starts with that friendly offer. A free consultation. Come in, we will review everything, no obligation at all. Nothing is free. The review is free because of where it quietly leads. The word advisor is not a protected title. Anyone can print it on a business card. A man cannot legally call himself a doctor without the training, but he can absolutely call himself a financial advisor tomorrow morning. And two completely different people hide behind that same word. One of them is a fiduciary. That is a person legally required to put your interest first, at all times, in every recommendation. The other is a salesperson working on commission, held to a lower standard. For years, that standard was only that a product had to be suitable for you. Not the best choice, just an acceptable one. In 2020, regulators nudged the bar up and called it best interest, but it still sits inside a commission arrangement. A true fiduciary would never accept. Picture 3 investments that all fit your situation. One of them pays the salesperson 3 times as much as the other 2. Under the old rules, steering you into the expensive one broke nothing as long as it counted as suitable. That is the gap the free review lives inside. When Ron's account was small, nobody offered him a steak dinner. Now that his number is big, he is worth the invitation. The seminar itself is built carefully. The first meeting is all education and no pressure. Charts, coffee, a friendly expert who seems to be on your side. Then comes the follow-up, one-on-one, where the actual product finally appears. By then you like the person, so you trust the pitch. That warmth is not an accident. It is the most valuable tool in the whole process. 2 products are built almost entirely to be sold at this exact moment. The first is whole life insurance. I'm not telling you it is always wrong. In a few narrow situations, it genuinely fits. But look at how the agent gets paid, because the pay reveals who the product is built for. On a policy costing $5,000 a year, the agent can earn 70% of your first year's premium. That is $3,500 in their pocket in year 1 alone. The commission on every year after that drops to almost nothing. The reward is loaded onto the sale itself, not spread across the decades you were supposed to hold it. This is also why these policies build almost no value in the early years. The money you pay in the beginning is largely paying the commission first. Meanwhile, that same $5,000 a year could go into a plain index fund. At 7% over 30 years, it would grow to about $470,000. The second product is the annuity. Roll $200,000 of your savings into one. A 5% commission hands the salesperson $10,000 on a single signature. That is the pitch that arrives precisely when your number is big enough to make the paperwork worth someone's afternoon. And once your money is inside, it is not easy to get back out. Most of these contracts lock your money up for 6 to 8 years. Pull it out early, and the insurance company charges a surrender fee, often around 7% in the first years. On that $200,000, changing your mind early can cost another $14,000. So the product pays the salesperson a big reward up front, then it makes it expensive for you to walk away. That combination tells you exactly who the contract was designed to serve. Every one of these works the same way. Each takes a slice off the top and lets time do the damage in silence. You never receive an invoice. The management fee is scraped off before you ever see your balance. The commission is baked inside a product you were never really meant to understand. There is no dramatic moment or headline. There is just a little less than there should have been, compounding into a lot less, year after quiet year. This is exactly why 750,000 is the dangerous number. It is the first time your pile is big enough that a small slice of it is worth serious money to somebody else. And a small slice is precisely the thing your brain is built to overlook. You will always notice a crash. You will feel a 6-figure drop in your stomach. But a 1% fee you signed once and then forgot about is the silent one. That is the cost that ends up taking the most. There is also a feeling that shows up at this number, and the salespeople count on it. When you cross into real money, you start to feel like you have graduated. Like you are now the kind of person who is supposed to have a guy. That feeling is not wisdom. That feeling is the product. The simpler your money gets as it grows, the safer it usually is. So here is what to do the moment you cross this line. First, find your number. Sit down and add up every fee you are paying, written as a plain percentage. Look for the advisor's fee. Then look inside each fund for its own expense ratio and add them together. If you cannot find these numbers anywhere on your statements, that is your answer already. A cost you cannot see is a cost designed to be taken. Second, ask one question of anyone who wants to manage your money. Are you a fiduciary in writing 100% of the time? Then go quiet and listen. A real fiduciary answers in one word. Everyone else answers in a paragraph, and the paragraph is where the truth hides. Some advisors call themselves fee only. That means they take money only from you, never a commission from a product. Others say fee-based, which sounds almost the same, but is not. Fee-based means they can take both. That one small word is the difference between a person paid by you and a person paid by the product. And before you sign anything, spend 5 minutes looking that person up. FINRA runs a free tool called BrokerCheck. The SEC has its own free database, reachable from investor.gov. Type in a name and you can see where they have worked, which licenses they hold, and whether customers have filed complaints against them. One complaint may mean nothing. A pattern of them tells you everything. It is free and it takes 5 minutes, and almost nobody bothers. Third, separate the two things you might actually be paying for. Paying someone once to build you a real plan is buying advice, and that can be worth every dollar. A good flat fee planner might charge a few $1,000s for a full plan, then they never touch your accounts again. Paying 1% of everything you own every year for the rest of your life is a completely different animal. That is renting a landlord for money that is already yours. And here's the honest part, because I'm not sitting here telling you every advisor is a crook. Some situations truly need one. A tangled tax picture, the sale of a business, estate planning around property, a husband or wife suddenly forced to manage money they never once handled. In those moments, paying a fair fee to a true fiduciary is one of the best checks you will ever write. The trap was never getting help. The trap is paying a slice of everything forever for a job you could have finished yourself in an afternoon. For most people, standing right at $750,000, the boring answer is the correct one. It is a total US stock fund, a total international stock fund, and a bond fund whose share grows as you age. You can set it up in an afternoon and rebalance once a year. Left untouched through every terrifying headline, that beats the expensive version most of the time. The real value a great advisor adds is not some secret stock nobody else knows. It is talking you off the ledge in the worst month of a crash. If you can be that steady person for yourself, you have already earned the fee. The day you cross $750,000, two hands reach for your money. There's the crash you can see, loud and frightening and plastered across every screen. And there is the slice you cannot see, quiet and polite and wearing a very nice suit. The crash you will survive, as long as you keep your hands still and refuse to sell. The slice is the one you have to hunt down on purpose because it was built from the start to stay invisible. So this week, pull up your statement, find the percentage, then ask the only question that really matters. Is this buying me anything real? If the answer is no, you just handed yourself a raise. Over your lifetime, it could be worth more than $1 million. Ron did that math 1 week last spring, and it changed how he heard the word advisor for good. If this was useful, hit subscribe, and I will keep the math exactly this honest. I will see you in the next one.